Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. It looks like after a rough start to the week for some markets, Friday ended with a lot of green on the stock market boards. He also has a special offer for our listeners. Market historian Bob Hoye from chartsandmarkets.com answers listener questions about central banks, what's behind some companies embracing Bitcoin, and why are hedge funds shorting the Nasdaq and Russell 2000. John Rubino from dollarcollapse.com talks about inflation hitting us hard from lumber to copper. He believes we're in a giant economic bubble that could collapse and throw us into a financial situation we have never faced before. Would such a collapse be survivable? Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Ray. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Good to be back, Jim.
Ross, Charts and Markets has a special offer for our listeners. Can you tell us about it?
For the next week, it's 25% off for new subscribers on an annual subscription. And if you visit the website, you'll be able to see, we've got an example up there of a piece that we did back in March related to the presidential cycle and what to expect as far as the stock market is concerned in the first half of these presidential years. So that'll give people a feel for the type of material that I do, and then we'll also put up a pivotal events, one of Bob's research pieces that where every week he touches on everything from stocks to commodities to the debt markets and precious metals. So people can get a little bit of a taste by looking at those, and we invite them to take out a subscription while they're there.
On the major markets this past week, the Nasdaq seemed to be taking it on the chin to start off, but then by Friday, the boards across the board, I don't know what other term to use, everything was green and up again.
Yeah, I mean, here's the Nasdaq. I mean, if it hadn't been for the last hour of trading, I don't know if it would have still managed to close up on the week. It had a pretty tough midweek area. Now, the whole market did as well. Now, we've been thinking that we could have been vulnerable to a bit of a shakeout into May, early June, and there was that small hiccup that we had. Not as much as you would normally expect, but if this was all that it was, then the push to the July-August high, which is the norm in these post-presidential election years, that could very well be in the offing. And, we've been having this rotation. As you say, the Nasdaq has been having a tough time, and so has the Russell. The Russell 2000 is underpacing what's going on over there in the Dow and the S&P. And, if you take a look at where the real winners are, it's the things like Deere or just some of these old stalwart, commodity stocks that are doing pretty darn well, Caterpillar, etc. So those have got the real leadership, and the money's pouring into them. The energy stocks have been doing exceptionally well, and that's the norm when you've had this pause in the crude oil price that we did there for the last month and a half. And for us, the continuation to the upside, I think, is still in the offing as far as the crude oil is concerned. So the energy stocks, anything in that sector, I think, still has some pretty good legs behind it.
Why is the Canadian dollar doing so well right now? Is it crude and lumber prices?
Well, and agricultural prices. You put them all together, and I've been thinking about selling my house for parts. With the price of lumber where it is at $1,700 and copper at $4.75, I think my house is now actually worth more than the land that it sits on. And I could never say that before. So we're into the mode here where everybody's just chasing after things. Lumber price at $1,700 was $1,500 a week and a half ago. The copper price at $4.75 was $4.50 a week and a half ago. Everything. Oh, corn. There's another one. We're probably trading around $7.25 right now on corn, and we're in what I consider to be an exhaustion mode, just to getting bid up significantly day after day. Price measurements there out of the 5-year base, and if you do a point and figure count, you could be ending up with something over $8, maybe around $8.20 on corn by the time we're finished. So these are the type of things that are really helping the Canadian dollar. And on the other side of the coin, it's been the weakness in the U.S. dollar. The U.S. dollar just got hammered on Friday. And that, in turn, is one of the good reasons for the strength in the Canadian. The U.S. employment numbers are just devastating. A quarter of what they were looking for. A big miss in terms of the estimates. So the dollar U.S. dollar under pressure, Canadian doing fine, and with that weak dollar, that's one reason we see the commodities doing well. And the other two commodities, the precious metals that we like to look at, they broke out of key resistance levels early or midweek. We'd been looking at just over $27 for silver and just under $1,800 for gold as resistance points. So they popped through those. That is a clear change of character, because these two items, they had been in downtrend since August, and this takes them out of the downtrend. You can look back, and it looks like, nice little double bottom here. Going to have then, I think, just a steady stair-stepping to the upside. Usually the early part of precious metals moves aren't very exciting. You'll get maybe a week or two of good price action. Then you'll get a big 40 to 60% pullback before the next leg up. So I think at this point, as of Friday's close, this thing is got some upside momentum. Gold probably in the 1840 to 1865, 70 range is the next resistance point. Support probably just under 1800, and you can buy the dips as far as I'm concerned, especially with some of the miners.
Ross, can you maybe again remind us about the special offer?
Yep, it's 25% off the annual subscription, and that's available for the next week.
Thank you very much for being on This Week in Money.
Thank you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Bob Hoye, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's based in Vancouver. Welcome back to This Week in Money, Bob.
Yep, good to be with you, and it was an interesting week.
Bob, you on your regular show on HowStreet.com, you like to answer listener questions, and we have 3 listeners asking questions this week. So we'll start off with Clayton. Clayton writes, Bob, have you noticed India? Do you think Modi is lost in space? He's the Prime Minister. Pushing the COVID button one more time to stay in power a little longer. They have closed the borders to enjoy the Twilight Zone coming to USA in September?
Yeah, Clayton, thanks for your notes. Definitely those political leaders with an authoritarian persuasion are pushing the Wuhan flu problem as far as they can for control freaks. It's not good for the country, and earlier in the year we noticed that Argentina and Turkey, South Africa, that their central banks were having a problem, and that problem means they're running out of liquidity. So they're having a currency issue and rising short rates issue. Now, we have found that historically, when you have lesser or outlying countries suddenly have a problem with their central bank and liquidity, that once it gets going and you're in a huge boom, are we in a huge boom? Yeah. Then it can eventually hit the senior financial centers such as London or New York, typically in the fall. So, fun question, and whatever they're doing there, if it's intrusive, it's not really very constructive.
Another question comes to us from a regular listener, Michael. Michael writes, Hi, Jim and Bob. An increasing number of companies are buying Bitcoin, often taking on more debt on already overbalanced balance sheets. This reminds me of the Hail Mary pass employed in football. Bob, is this a reflection of their boundless optimism in Bitcoin, or is this an act of desperation by over-leveraged companies and storied companies with no profits? My second question, hedge funds are going heavily short the market, particularly the Nasdaq and the Russell, as they continue to short the Treasury market and the U.S. dollar. And again, he brings up the word Twilight Zone. A lot of Twilight Zone fans out there. Well, first of all, is going to Bitcoin for these big companies a Hail Mary pass, a la Doug Flutie and Boston College?
I think it's just a compulsion to get in on a hot item. And the hot item, whether it was in 1929 in Europe, the hot item was margarine stocks. Hey, lots of glamour there. So Bitcoin has got all kinds of magic intonations about it, so they're buying it, and they're doing new ones all the times, and it's been a fabulous market if one is actually playing it. And but it, like anything else, it's sure, let's call it high tech, let's call it whatever, but it certainly has become, the sector has become the favorite of speculators, and the tendency of speculators is to take something too far until it crashes. And then I noted something here about the Russell. We've done some work on the Russell small caps relative to, say, the S&P. And because of such incredible things going on in the U.S. with deliveries and shipments and everything like that, the transports are still firm. So the old Dow theory may not be effective, but what we've noticed is that you now have a negative divergence from the Russell small caps to the S&P, which could be maybe similar to a Dow theory sell from the transports. Who knows, but it's been interesting to follow it. And then as far as the do Twilight Zone goes, we've had sunshine possible on seasonal elements through until mid-year. For example, copper can have a high in July. Lumber, which is crazy. Well, both of those, lumber and copper, are going straight up. And as I said, copper can have a seasonal high in July. and lumber can have a seasonal high in June. So, and they're both getting overbought. So then after mid-year, we figured that the sunshine could turn to twilight, and then after August, if there could be some distress out there, in which case the metaphor could be the twilight zone. So we're watching for it. And thanks for the question.
Regular listener Kathleen always likes to put a musical reference into her question, and no exception this time. Kathleen writes, "Hi Jim, hi Bob. Singer-humorist Eddie Cantor was no stranger to margin calls even prior to the 1929 crash. He was worth $1 million before the crash." Gosh, that would be like $250 million now, wouldn't it, Bob?
Guess so.
I think, yeah. I mean, 25 cents would get you a luxury steak dinner back then. After the crash, he was more than $200,000 in debt. Prophetically, Eddie recorded a faithful monologue on Tuesday, October 29th, 1929, and one of the excerpts from that song, nowadays, when a man walks into a hotel and requests a room on the 19th floor, the clerk asks him for sleeping or jumping. Is this market something that we have to be really aware of, and are people going to be jumping out of 19th floor windows again?
Yeah, thanks for the info on Eddie Cantor. I wasn't aware of that, but I do recall, many, many years ago, using a quote about the stock market by Groucho Marx. And Marx was another showbiz big name who was playing the stock market heavily and then took a massive hit. So, and this is, a bull market is so compelling. It's the loveliest thing in the world, and it makes you money every day. I know at one time I was quite disappointed that there was no trade on Saturday and Sunday. Wasn't making any money. Mm-hmm. At any rate, there will be some great disappointments when the market breaks.
We'll have more with Bob Hoye when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your eye before we did the show, inflation. Is it going to be a big deal? Well, Warren Buffett, one of the richest men in the world who knows how to usually swing money around and get the most out of it, he says there will be a red-hot recovery. Will inflation be a big bugaboo for us?
Yeah, there are, and also, Jim, I'm seeing the permanent commodity bulls are singing the song about the commodity supercycle. And yes, we are in a terrific boom that was impaired for a while by that enormous shutdown and lockdowns and the hardest hit to employment ever. But the main thing is that a bubble was likely to complete in this year with attendant, boom in the economy side, which is happening. And you're going to see firming industrial commodities with this, and we've got lumber and copper going straight up. And then also you've had very good strength in the agricultural prices because, and this is one I went on about a few years ago, but it took a long time to hook up, and that is that with the climate cooling, the growing season in many regions in northern hemisphere have been coming in, sort of making planting a little more difficult and making harvest a little more difficult. And then plus you're in a boom, so the even the grain prices have been very strong. As a matter of fact, corn is so strong that it's giving some excessive signals. So now the question is about the old line by commodity bulls about whether this is a super cycle for commodities. And you never see it written about the super cycle in stocks. And this is where we're in. This is, to my eyes, it has a lot of comparisons with the 1929 Great Bubble, and the one before that was 1873. It just, a number of things are adding up to say that this is one of the greatest bubbles in history. And as we noted earlier in the year, that the sunshine could run through to mid-year, and so we're watching for excesses here. And the other thing to note is that the pattern has been, for 300 years, you have a great boom in commodities. And if the commodity bulls want to call it a super cycle, that's fine. But in 2008 and 2011, you set prices. 08 was crude oil up to $147, and then gold and silver and the grains and whatnot in 2011 were huge. So that had, I remember, we also did like copper and lead and zinc on a deflated basis. And the rise in the deflated price was the greatest in 100 years. And it was not only the biggest in 100 years, but it was the biggest by huge. And that's where then in 2011 we concluded that there could be a secular bear market for most commodities. But then what happens is you have the super bull market for commodities, and then about a decade later you have the super bull market for stocks and bonds, which we have now. And let's call it a super cycle for stocks. And when this blows out, and it will, then in the past, every super cycle in stocks has been followed by a lengthy contraction and deflationary pressures on many price series, except for gold, which the real price goes up. So we live in the financially the most fascinating times in a couple of generations, and I'm loving watching it, Jim. It's just great to be watching it.
A friend of the show, Stuart Muir from ResourceWorks.com, mentioned that a study just said there will be a 500% increase in the use of minerals in the effort to decarbonize the economy. So in other words, there's going to be a lot of steel, copper, aluminum, silver used, for windmills and wind turbines, solar power, and so on.
I take that, Jim, as the old story. There is no way that if we go into a contraction discovered late in the year, there's no way that the economy is going to be able to afford fanciful energy delivery through solar or through windmills. I mean, the amount of land needed for those two items is staggering. And then the other is that the amount of steel and cement and coal and everything else that you have to use in order to make these things is beyond imagination. So the view on fanciful energy demands is probably won't be able to withstand a severe post-bubble contraction. I think it's just all those fanciful ideas are just going to get tossed. It's going to have to go back to being very practicable and very cost-sensitive and all that sort of stuff. So, the interesting thing, as I said, the two hottest commodities now are lumber and copper, and they are both reaching excesses. Well, lumber beyond anything in history, but copper is reaching the excesses it reached back in 2007. So,
sure. Well, I mean, lumber, a month ago, lumber had added about $25,000 to the cost of building the average American home. Now, that cost has skyrocketed to $36,000 added to the
Jim,
price of that home.
Yesterday.
And that, yeah, so in 1 month, it's increased by, about $10,000.
Yeah. No, it's incredible. It is one of the most incredible bull markets for lumber ever. But as I say, it's getting measurably extended, and copper is measurable. It's what the weekly RSI is up to 82 yesterday, and the highest it got in 2007 period was 84. So the bull market for copper is almost completed, and also keep in mind the seasonal. You can have a nice high for copper in July, and then you can have an equally effective low for copper in November. Lumber can set a high in June, and it can set a low in October. Crude oil, hell, it can set a high somewhere in here into September, but it can do some severe seasonal lows come January, February. So this is where the old saying is, sell in May and go away. But then traveling's beginning to come back again now. So there are measurable excesses out there in the financial markets and in the commodity markets. And it looks like there's a huge amount of liquidity that's going to bid up every hot game in the world. But what you find out is that that's not real liquidity. It's borrowed money, in which case this is what happens in every big speculative conclusion to a bull market, is that where the Fed may have been providing all kinds of ease and all kinds of credit, when it goes bad, the power shifts to the margin clerks. And if the recipe of central banks providing capital to the markets worked, there would have been one continuous bull market from 1913 when the Fed was formed. And also we should recall that as the Federal Reserve was being formed, the promoters behind it knew that a credit crisis preceded a recession. I mean, that's old stuff. So then they had the theory that the Federal Reserve would be the lender of last resort and would prevent the financial crisis that preceded recessions. It is still a very appealing ideal, but there's been 18 cyclical recessions since the Fed opened its doors for business in January 1914. So the theory does not work. And yet here, you got all kinds of hot speculators bidding up whatever, because they're convinced that the Fed is going to be even more reckless under the Biden administration. But over the last couple of decades, the Fed has been unimaginably reckless, every day during the trading hours. And it never, when they start pushing out credit, they can only push out credit so long as there are speculators out there demanding credit. And when a crash comes in, then suddenly nobody wants any credit. They're all covering margin calls. And the Fed, even if it wanted to be reckless, it won't be able to. So it's going to be interesting to see how it works out. And Jim, as we've been stating, the sunshine would run into about mid-year. And then August might see a little twilight. And then after August, you could see that scary TV show, The Twilight Zone. And one might as well be prepared for it. And as we have these hot markets, begin to build a little liquidity in your own account. It's just a very prudent thing to do.
A survey showed 64% of Americans now are optimistic. Do you share their optimism?
Yeah, because it's a hot, good market. When a strong stock market, Jim, doesn't exist by itself. You have to have a boom. It's a period when financial people get very busy, but in a boom, everybody gets busy. So this is where, despite the extraordinary setback with the COVID restrictions, the underlying boom is still there. So what we're now watching for is the signposts from the credit markets that'll tell us that the boom is then becoming vulnerable, and then what you're going to get, of course, what you get in any contraction, eventually the general public gets gloomy. So this one at 64%, I didn't take that as being positive because of the Biden administration. No, it's just positive that goes with a fabulous boom. And it was just somebody putting a number to it. So we can perhaps keep track of that number over the next 6 months or so. We have a voice coming from eternity here that's very regarded, and he's supporting our research.
Charts and Markets is offering a 25% discount on new annual subscriptions. Check out the homepage of the website for a sample of the type of technical analysis they offer. Go to chartsandmarkets.com.
Thanks very much, Sean, and I hope we can get in touch again sometime.
My guest has been Bob Hoye, market historian and chief investment strategist for chartsandmarkets.com. Coming up, John Rubino, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website dollarcollapse.com. He's speaking to us from near Port Angeles, Washington. Welcome back to This Week in Money.
Hey, Jim. John,
is inflation the big focus now?
Inflation is a very big deal right now because what's happening is we've had hidden inflation for a really long time, where the central banks of the world created immense amounts of new money and dumped it into the system and pushed interest rates to artificially low levels, which would, in theory, cause inflation to ignite. But what happened was it was very narrowly focused inflation. All that money poured into stocks, bonds, and real estate. And those financial assets just soared. You know, they've had epic bull markets in the last decade, while milk and bread and cars and things like that didn't really go up that much in price. So the government was able to say inflation is well behaved because their official inflation numbers don't include financial assets. But if they did, we would have been in an inflationary environment already. So what's happening now is they're still dumping huge amounts of money into the system. Interest rates are still artificially low, but the price increases are starting to spread to other sectors. Lumber and copper and iron ore are through the roof, and a lot of food commodities are way up, and cars. You know, used car prices are like 50% higher than they were a couple of years ago, and so it's starting to spread into things that people notice and that the governments of the world are forced to include in their inflation measures. So what we're going to see in the next couple of years is inflation exceeding the 2% level that normally triggers central bank tightening. And the central banks are trying to avoid having to tighten by saying, oh, it's transitory. It's just going to, you know, prices will go up for a little while and then they'll settle back down. And, you know, it's not clear that that's true because wages are starting to go up. At least in the U.S., there's a big labor shortage all of a sudden, you know, right after the pandemic lockdown. The companies that shed a lot of workers are having a lot of trouble tracking those workers down and rehiring them. Even new age companies like Uber and Lyft are reporting shortages of drivers. Now, when there's a shortage of something, the price goes up. And the labor markets are no exception. That means people are going to get paid more in order to come out of retirement or, leave whatever they're doing now to go work at some other place that needs people desperately. And so we're going to not only see commodity inflation and some product inflation because of the commodity inflation, but we're going to see wage inflation. So we're going to see financial assets much higher, commodities and the things made from commodities much higher, and wages much higher. So there's no place to hide if you're trying to fake low inflation and you're a government, right? They're going to have to admit that inflation is up and it's going to be up for a while. And so then the question becomes, what do the financial markets do? And I think it will not be pretty when they realize that this transitory inflation is actually semi-permanent.
Is inflation now comparable to the 1970s when they still used to include the cost of housing and fuel, which they don't do now?
Well, there's a guy named John Williams at a company named Shadow Stats that tracks the consumer price index as it would be if we still used the same measurement conventions as we did back in the 70s and 80s. And he says, yeah, we'd have double-digit inflation already, and which is kind of what I was saying, that they were hiding it because it was narrowly focused lately. But now it's broad-based, which means John Williams's numbers are going to start to look more and more realistic in this world. They looked, like way, way out in left field for most of the past decade because official inflation was 1 or 2%, and he was reporting 9 or 10%. Pretty soon, those two trends are going to intersect. And John Williams level inflation is what we're going to be seeing out there in the real world. And that is going to be very, very destabilizing if it turns out to be true.
At what point would inflation have an effect on interest rates?
Well, it's already starting to. Interest rates have been going up for the last year. The 10-year Treasury yield in the U.S. Was 0.7% a little over a year ago. Now it's 1.6-ish%. So it's almost a 100 basis point increase in that time. That's not quite high enough to destabilize the financial markets, but at some point out there, if it keeps going up, we will reach a point where interest rates become the problem. And the reason higher interest rates are a problem for, say, financial assets is, first of all, by definition, higher interest rates mean lower bond prices. So that's a bond bear market already if interest rates continue to go up. And they also affect the stock market because stocks compete with bonds. So if bond yields go up, then that makes stocks relatively less interesting. And since stocks are already priced for perfection, they could just tank. If a bunch of money started pouring into treasury bonds because treasuries yield 3%, and then stocks with all these air pockets under them could drop by 40 or 50% very easily. So we could have an equities bear market at a minimum if interest rates start going up. And we could have all kinds of other horrible things happen in the economy because, we're a highly leveraged system, or really the whole global financial system is over leveraged. So higher interest rates could destabilize pretty much everything.
Well, I remember in 1981, the Canadian government was paying 21% on a Canada savings bond. Could we see interest rates go up to that again?
Well, that was what they had to do to fix the currency crisis of the 1970s. They had to raise interest rates dramatically in order to make their currencies more attractive. They don't have that tool anymore because they were actually in pretty good shape financially back then. There wasn't that much debt. So if interest rates went up, that didn't destroy huge sections of the global financial system. We were able to handle it. This time around, everybody's so deeply in debt that if you raised their interest rates from, 0.7% or 2% or whatever it is they're paying now, depending on who they are, to 15 or 20%, it would bankrupt them. It would bankrupt most major governments. It would bankrupt a lot of big businesses, many, many millions of individuals. So we can't do it. We might try to raise interest rates, but we'll never get anywhere near 20%. I suspect that 2.5 or 3% on the 10-year U.S. Treasury bond would blow up the global financial system. So we won't get much further than that.
Is the Fed bank rate always in sync with mortgage rates?
If by the Fed bank rate you mean the Fed funds rate, the overnight rate?
Yeah.
Mortgage rates. Yeah, mortgage rates key off of the 10-year Treasury yield. That's why I keep bringing that one up, because that's a crucial interest rate, because so many other things are linked to it. So if 10-year Treasuries keep going up, mortgage rates have to keep going up. And at least in the U.S., I assume it's the same thing in Canada, house prices are insanely high. They're only affordable for most people because mortgage rates are so low. So if mortgage rates start going back up, in the U.S. they're below 3% right now. So let's say they go up to 4 or 5%, which is historically still pretty low. That would price out tens of millions of people from the houses that they might otherwise buy. And it would make it impossible to refinance your mortgage and get kind of an improvement in your financial life by having a lower mortgage rate. So that would blow up the housing market, which would probably in turn tank the economy, which would, if stocks haven't already tanked, it would tank them. You've got a lot of dominoes out there, any one of which could start knocking down a bunch of other dominoes. And they all key back into interest rates, which in turn depend on inflation. So we've got a pretty coherent story out there for almost the first time in the past decade, where you can see exactly the progression of how this whole thing unravels.
Is this real estate bubble different from other real estate bubbles?
Yeah, this is a weird one. In the past, it was huge increases in home sales, leading to rising prices, leading to all kinds of dysfunctional behavior, like mortgages being given out to strippers and hairdressers who make all cash and report fake income and stuff like that. There's not much of that going on right now because there's a shortage of houses. People don't want to sell their house, in part because of the pandemic. I mean, moving is a huge pain, and moving during a pandemic lockdown is orders of magnitude more complicated than moving in normal times. So there aren't that many houses on the market, which means if you want to buy a house, you got to pay way up, and mortgage rates are way low, which means, even if a house is expensive, you can maybe kind of sort of afford it. So if a nice house comes on the market in many parts of the U.S., it gets snapped up on the day that it's listed, or it gets a bidding war. And somebody was telling me the other day that they saw a house go for $100,000 more than the asking price, which is like hitting the lottery if you're a home seller. So this is a different kind of housing bubble. You might be able to still call it a bubble just because prices are behaving in such a crazy way, but it doesn't have all the frenetic moral hazard stuff going on as the last one did. But it's also not really the important bubble. We've got 4 or 5 other bubbles that are more important than the housing bubble this time. And last time around, it was the epicenter of the bubble economy, and then it was the cause of the Great Recession. This time, housing is almost an afterthought. Tech stocks and cryptocurrencies and government bonds, and it goes on and on. There are much bigger bubbles out there than housing.
Is the cost of building a house added to the land price appreciation causing the price of homes to increase even more?
Oh, yeah. Lumber alone has, I think, quadrupled in the last couple of years, which has added something like $38,000 to the price of the average new house in the U.S. Plus, copper for the wiring is way up, and any kind of steel that you need in the house is way more expensive. So it just goes on and on. In an inflationary spiral. So new houses are much more expensive to build, and existing houses are in part tracking that price increase on the way up. So you're seeing double-digit increases in home prices in a lot of places in the U.S. And remember, this is 11 years after the Great Recession, with housing prices going up continuously that entire time. So they're not going way up off of a low base. They're going up off of a record high base, and they're still soaring. So, so part of it is raw materials. Part of it is what I was saying before about there being a shortage and easy financing if you've got good credit, things like that. But it's kind of a perfect storm for house prices. And, it's not the main bubble, but it is still a bubble. It could still blow up and cause a lot of trouble, and it will probably when interest rates go up.
Does the stock market look like it's topping or going to move higher?
It's starting to look choppy right now, and I think part of the choppiness in the stock market is that first of all, there's sector rotation going on where money is flowing out of the really, really high-priced tech stocks and into more defensive stocks. I just saw a headline about money pouring out of tech stocks and into gold, utilities, and bonds lately. And I would have to research that to say that it's true, but there is a headline to that effect. And that's a sign that that the really, really frothy, bubbly part of the stock market may be getting to the end of its run. But very seldom do bubbles, like the current tech stock bubble, just flatten out and be choppy for a long time. Usually they spike and they get super volatile at the top and then they tank in order to bring prices back down to a reasonable level. So history says that we're at and then they tank part of the process. But history's never seen central banks pumping this kind of money into the system. And there has never been this kind of financial uncertainty globally before. There's a guy named Martin Armstrong who has been right for a long time here about the direction of the stock market, so he deserves a lot of cred. And his take is that, everything's a mess out there, but the U.S. is marginally less messy than the rest of the world, therefore a lot of safe haven money is going to flow in, and they're not going to be price sensitive when, somebody who's desperately trying to get out of Brazil or China with their money, they're not going to look at Google and say, oh, it's at 17 times sales. I'm going to wait till it's 15 times sales before I buy it. They're just going to buy it. Or, a Miami condo, I'm going to wait till it drops to $400,000 from $600,000. That's not the way they'll act. They'll just buy that condo. They'll buy that U.S. stock at whatever price, and that will support our asset prices for a little while longer. That's plausible. And you can look at it either way. History says there's a crash coming. However, global capital flows might delay that time for a while.
Martin was our guest last week.
Okay. Well, then he's a sharp guy. Is he still saying that stocks are going to keep going up?
Well, again, he said it's a messed up world out there, so, keep your head up.
Yeah. It is a messed up world. That might end up being the big theme here, is that this is a global thing instead of a local thing. Crises used to be more, one country screwing up in some fundamental way, but everybody else on sound money and not quite as screwed up. This time it's the opposite. Pretty much everybody is screwed up with a tiny number of exceptions. Like, believe it or not, Russia is not making the same mistakes that the developed world is making. And of course, as always, you've got Switzerland and places like that where they're in reasonably good financial shape. But man, the big developed countries, including China in that, are all wildly over indebted and becoming more so every minute of every day. So I don't know where you could hide geographically and be sure that you'll be okay from what's coming.
Well, China came out and told us, I think, a week or two ago, they're concerned because in 4 years their population will actually start to decrease, and they were trying to become a consumer-based economy instead of just relying on exports. Does that tell you something about when you try to centrally control an economy, because they only allowed one child for the longest time?
Yeah. Well, the whole population thing is worthy of an entire show if you want to do one sometime on it, because it's a fascinating subject. Because we are wildly overpopulated. There's arguably 5 billion too many human beings on this planet, and that's the cause of an awful lot of horrendous problems. But when you take an overpopulated and over-indebted society with social welfare programs that take care of retirees and stuff like that, and then try to slow down population growth, you end up with a shortage of young people to support the retirees, and you get a gigantic financial crisis from that. So we're kind of in a damned if you do and damned if you don't situation right now. And China kind of exemplifies that, because they took what I think was, it was harsh and in many ways cruel, but it was mathematically the right thing to try to do. Their population was exploding. They were over 1 billion people 2 decades ago. And so they recognized that they would be facing absolute mass starvation and civil unrest and just chaos if their population kept growing like that. So they took steps. They took harsh steps to try to stop it. They succeeded. Their population actually shrunk last year, apparently. So from the point of view of the original goal, that was good. But now they've got, like you said, they've got this issue with not enough young people to support the old people. And that's a whole different problem. So we have these problems regardless now. We put ourselves in a situation where anything we do to solve one problem, in many cases, makes other problems worse. And there's really no way out of this. That's why I'm an optimist in the sense you can make a ton of money if you play this right, but a pessimist in the sense that there is no happy outcome for the human race over the next, say, 50 years. We've got financial chaos, very probably geopolitical chaos, and demographic and environmental chaos thrown in on top of it. So, those are all baked into the cake by our stupid decisions of the past. And all we can do as individuals is try to manage our own finances and our own life situations in a way that gives us and our families a chance of coming through this reasonably unscathed. But the big countries of the world will not come through this unscathed at all.
Is what's happening in the U.S. comparable to Japan in the late 1980s, early 90s?
No. And that's a good question, because that's something that gets brought up a lot, where people say, oh, look, Japan's government debt to GDP ratio is twice as high as America's. That means we can borrow money for another 20 years without collapsing. The problem with that argument is that it looks at just government debt, and that's a false way of analyzing a society's leverage. You need to look at all debts. Government debt, your mortgage, my credit cards, our kids' student loans, our cousins' car loans, all of those things count against a country's ability to pay off its debt. And the U.S. total debt to GDP is vastly higher than Japan's. So we're already way more indebted than Japan is, which means we're the country leading the way off the cliff, not Japan. They could still go bankrupt first, because their government debt is so high, and so they could have a crisis at the governmental level where the government sees its interest rates go up and can't borrow at a rate that keeps its interest costs low enough not to bankrupt it. That could all happen to Japan. But if you're just looking at total debt and assuming that the country with the highest debt to GDP ratio is the one that's going to go first, you'd pick the U.S. because we have more debt to GDP than any major country out there. There's a few smaller ones that have higher numbers, but who cares about, Greece or someplace like that from a global standpoint? If we're looking at global chaos, the U.S. may well lead the way at some point, despite all the terrified capital flowing into it.
How far can the debt bubble go before it bursts?
Well, that's the big question. It shouldn't have been able to go this far. The fact that everybody's making the same mistakes and all the central banks are kind of synchronized has allowed us to leverage the global financial system to a point that didn't seem even reasonably feasible a decade ago. But we went ahead and did it. So I thought we were going to blow up in 2008, 2009, and we didn't. So I have no credibility when it comes to the timing of stuff like this, but I think we've baked into the cake some kind of a huge crisis. So it just depends on when all this stuff, like when inflation starts to really pick up in a visible way and what that does to interest rates and what the financial markets do in response to rising interest rates. And that all could happen this year or next year. We're already going to start reporting really high inflation rates in the U.S. in coming months. And if that sends interest rates higher and sends the markets into some kind of frenzy, then it'll be a 2021 story. But it could go on a ways longer. But the important thing to understand is that it's coming. So it really doesn't matter whether you're taking steps right this minute or you took them 5 years ago to protect yourself. You're protected, and that's the important thing. Get the insurance now and then don't worry about the timing of the landslide or the forest fire. You insure yourself against it now, and then you can relax knowing that you're protected when and if the thing happens.
Are the major gold miners an indicator for the gold market going forward?
That's a great story in precious metals because, gold and silver are up from the last few years, but not dramatically so. But even so, gold at $1,800 per ounce is a profitable level for the big gold miners. If you're a producing gold miner and you're selling your gold at that price, you're generating a lot of free cash flow. And it was Barrick, Newmont, and Agnico Eagle, I think, that just reported lately for the first quarter. And their numbers all kind of said that. They didn't have a big production quarter in terms of year-over-year growth, but their free cash flow was up nicely. And what that means is that it makes the big gold mining stocks more attractive because their finances get better. They pay off their debt, they increase their dividends, so it's a more profitable stock to own. And at some point, they need to replace the reserves they're running through right now, and their exploration programs are not doing it, so they're going to start buying up the juniors. So if you're a junior mining stock, and you've outlined a tier 1 or near tier 1, which is to say big and easy to get at gold deposit, the majors, with all that money coming in, burning a hole in their pockets, are going to be lining up at your door pretty soon and offering you really nice amounts of money to join them. So I think the next couple of years, assuming gold holds this price, and I think there's a pretty good chance that it stays in this range or goes up from here, one of the big stories will be M&A activity in the gold mining sector and the nice effect it has on the junior mining stocks. So now's the time to grab a few juniors.
How is silver looking?
Yeah, silver's better than gold, really, from here, because it's an industrial metal as well as a monetary metal. So it benefits from all the inflationary stuff we talked about that will make precious metals go up, because they're seen as inflation hedges. They tend to rise when currencies are being debased, as they are now. But at the same time, most of the big governments in the world are aggressively funding infrastructure and clean energy programs, in part as a way of keeping their economies from collapsing into deflationary depressions. And silver benefits from that. Silver is used in electric cars and solar panels and microchips and all kinds of other technologies that relate to infrastructure and clean tech. So there's a decent chance that the combination of investment demand and industrial demand will cause a shortage of silver out there, which will cause the price to spike. So, here's the math for silver, I think, in the next few years. Gold goes to $5,000 US an ounce, and the gold to silver ratio goes to $25, or 25, which is to say it takes 25 ounces of silver to buy an ounce of gold, and that gives you a $200 US an ounce for silver price. And I think that is a reasonable target for silver, which is, 10 times almost from here. It's, $25, $26 US an ounce right now. So, I guess that's 8 times or so. But that's, I think that's a very reasonable move for silver, in part because of the things I just talked about. The fact that a shortage could easily happen when investment demand slams into industrial demand, and the fact that there's tons of hot money sloshing around out there. If silver just does a Dogecoin or an Ethereum kind of move, it's at $200 an ounce easy. Doesn't even need any kind of fundamentals. It just needs a small segment of the world's hot money deciding that, that's an undervalued asset. Let's bid that up this week, and that could happen easily for silver because it's a relatively small market that could be easily pushed around by a relatively small inflow of hot money. And I think that silver is just in line for something like that, even if none of the other good stuff happens.
Do you think sell in May and go away will work for junior mining stocks this year? No
idea. I never know what the short term. I always think I know, but I'm never right about short term moves in markets. So, with the junior miners, the fundamentals are awesome. They could easily start on a parabolic move this afternoon. But at the same time, there's the risk of that stock market crash we talked about before. If inflation spikes, which spikes interest rates, which tanks stocks, that will probably pull down everything, including the gold and silver miners. So you'll have a really sharp break in their price temporarily. And that would impact the junior miners even more seriously because they're more volatile. You don't really have a lot of fundamentals with the junior miner, like earnings or dividend yield or anything. So, they can theoretically go to zero if you're terrified of the broader world. So I don't think you can say anything with certainty about the near-term action in any segment of the financial markets, and definitely not the mining stocks. But I think the longer-term fundamentals are awesome. So the way I would approach them, if you're new to the junior mining sector, buy a few now, and then get on a program of regularly buying shares in the really high-quality junior miners. And if they go up, great. Your first batch makes you a lot of money. If they go down, cool. You get to buy some more, more than you would have been able to buy with the same amount of money. Just do that, knowing that the fundamentals will work out in the future. At some point, these things go straight up for a period of months or years and make their early investors 10 or 20 times their original investment. That will happen. You just can't know exactly what happens on the way. So gradually buy these things. Make sure you've got a source of information that allows you to pick the good ones, because the crappy ones are going to zero no matter what. And you don't want to own them if you can help it. But the good quality ones will work out in the end with fundamentals unfolding as they are.
Looking back at free trade, was it a good idea?
Turns out that it wasn't. And I'm saying this as a former hardcore libertarian free trader who honestly thought that if people who were good at something did that thing and then traded with people who were good at something else, comparative advantage in economist speak. If that was the way of the world, everybody would get richer. But it turns out that, we had a lot of good paying factory jobs here in the U.S. that just evaporated, and were not replaced by anything that allowed yesterday's factory workers to maintain middle class lifestyles. And that has almost destroyed American society. So we are going to have to, one way or another, bring back manufacturing to the U.S. I don't know how you do that, but we need to find a way to do it. Because you can't have a huge section of society doing great because they're tied into international markets and they work online, where an almost as large segment of society is just being crushed and nobody's addressing their needs. So either the guys in charge now take serious steps to bring back manufacturing and other high-paying, potentially unionizable jobs to the U.S., or we get some kind of a social revolution in which a serious populist, in other words, a Donald Trump with an engaging personality, gets elected and just starts tearing things out by the roots, with who knows what kind of impact on the rest of society. And I'm not optimistic about us finding a wise way out of this. So I think we'll go the chaotic route, just because we're doing the stupid thing on almost every other set of choices, so we might as well make it politics too.
Is the microchip shortage affecting the economy?
Yeah, that's a very big deal. And it's not a funny story, but it's one of those ironic unintended consequence things where, the pandemic hit, we locked everything down, which I think is going to turn out to be probably a mistake in a lot of cases, but we did it. And while we were all stuck at home, we all bought new phones and new tablets and new laptops, and that soaked up all the microchips that were being produced out there. But it turns out microchips also go into cars and refrigerators and stoves and pretty much everything else that is not a smartphone. And there weren't enough chips to satisfy the demand from those other industries. So we got car plants shutting down, and if you're building a house and you're ready to move in and you call up to get your refrigerator, they tell you, "Oh, I'm sorry, there's a 6-month waiting list for that model because we don't have any microchips." So it's really screwing up the old just-in-time inventory system in a lot of industries. And it doesn't look like it goes away anytime soon. They're talking about another year or two of chip shortages out there. So that's yet another thing that's making the system not work very well right now. And it's yet another inflationary thing, because everywhere there's a shortage, prices go up. So yeah, maybe you can get that fridge you want, you can get to the front of the line, but you're going to have to pay way up somehow to do it, which means the cost of your house just went up in an unexpected way, and your disposable income just went down. So yeah, it's a mess. Everything is a mess. I'm sorry to be not so optimistic here, but remember, you can make a ton of money in precious metals and a few other things if you time this whole thing right.
Going back to lumber for just a second, on Vancouver Island, which is just north of where you live, they now have increased police patrols because people are cutting down big trees illegally for the lumber. Because one of those big Douglas firs could be worth what, $50,000, $100,000?
Yeah. See, that's what happens in an inflationary society. Morality breaks down in a lot of ways, because suddenly things that you walk by every day without giving it a second thought, those things are very valuable. And, in inflationary societies, you see people tearing wires out of houses and stealing components of cars for the meltdown value and stuff. And that's alien to us right now, because we have not been in an environment where it was worth the risk of stealing, the wiring out of a house or something for most people. But as the price of that stuff goes up, the risk-reward ratio changes a bit. And so you see these weird kinds of crimes, or where people steal solar panels off the roof of houses. It's a world you don't want to live in, but it's a world we're blundering into. And you're seeing it where people are chopping down these old nice trees, just because those trees are extremely valuable all of a sudden. If it's worth, $20,000 for one tree, then it's worth the risk maybe. So, yeah, hopefully we figure this out ahead of time. But I'm not optimistic, and I'm afraid that the whole moral hazard societal breakdown thing is going to be yet another depressing story going forward.
What do you think the end game is for Agenda 2030, the Great Reset?
Well, I think the 1% constitute basically a separate culture. And they get together, and, like you and I would get together in a bar, and we'd talk about how we would save the world if we were the dictator, and we throw our ideas out and make fun of each other's preferences and stuff. So the rich guys of the world kind of do the same thing when they go to Davos or other, meeting places of the rich and powerful, with the difference being they're not just speculating. They actually have the power to try to bring some of this stuff around and about. And it looks like some of the things they would like to achieve are dramatic population growth, which I think is a good thing if it happens voluntarily, but I'm not crazy about the idea of it being imposed by a dictatorship.
Population growth or depopulation?
Depopulation. Yeah, I'm sorry. Dramatic decreases in population. Yeah, I'm sorry if I said growth. I definitely did not mean that. So, instead of the population increasing, they want it to decrease by several percentage points a year, or maybe faster. And they want to rework the way the economy operates to use fewer resources, because they see us using up the world's resources. Their concerns are valid in a lot of cases. The problem is that to have all this stuff imposed via a dictatorship brings with it a lot of unintended consequences. I mean, the obvious one of which is we lose all our personal freedom while all this stuff is being implemented. So that's what concerns me about this stuff. I think they will go for it, and I think they have the power in a lot of cases to influence the world in their direction. But we'll see if it's possible to completely impose all of this stuff. One of the things that they say that got a lot of press is you'll own nothing, but you'll be happy. And I think what they're saying is that the sharing economy will spread to different parts of the system, where, for instance, if you now have a chainsaw that you use once every 3 months, in tomorrow's world, you'll just use your phone to order up a chainsaw via the appliance Uber service that just brings you the chainsaw. You use it for 4 or 5 hours, you give it back to them, and that's that. In a lot of ways, that's an attractive world, where you don't have as much clutter in your garage, you haven't spent as much money up front to be able to function, and that's okay. But again, if it's imposed via a dictatorship, that's not a good thing. Although if it evolves via market forces, I could see participating in a world like that on a lot of different levels. So yeah, I'm intimidated and concerned by especially the way this vaccine thing played in. These lockdowns look like, or let's put it this way, a cynic might say that these lockdowns look suspiciously like the population of the world being softened up for something more serious in the not too distant future. So it could be that. It could be that, they didn't start the pandemic, but they didn't let it go to waste either. And that they're creating mechanisms to be able to control populations in the future. And we're signaling that we're okay with that we're willing to be herded around like sheep, if the government can come up with the right narrative. And that scares me. I don't know what the solution for that is, other than make sure your finances are set up so that you benefit from the inevitable chaos from all this stuff. And, having a lot of capital on hand makes a chaotic world a lot less chaotic for you as an individual and for your family. And that's really it. I mean, I don't think we have any societal solutions where an individual's vote matters or anything anymore. I think we're just going to have to ride this one out.
Would the world be a better place without central banks?
Oh my God, yes. Well, like today's central banks, they are almost the root of all evil in the world today. And that is because they have basically financed the over-leveraging of the world over the last 40 years. If central banks weren't allowed to create money out of thin air, we wouldn't have the financial crisis looming that we have right now. There could still be central banks in a well-run world, but what they would function as basically a bank teller window, where you take your gold there and they give you dollar bills for that gold, and then later you take your dollar bills there and they give you gold. They exist to exchange the base money, which is gold, for the currency, which is the paper or the electronic money that we use to buy and sell stuff. And that's it, nothing else. And instead of being the most powerful entity on the face of the earth, the U.S. Federal Reserve becomes, a local bank or something like that. And that would work. But other than that, central banks should not exist. They really have turned out to be way more trouble than they're worth.
What do you see ahead for cryptos?
That's a tough one, because cryptos are an emerging asset class, which means we really don't know what they are yet. Nobody actually does anything with cryptos, or not very much yet. But that's starting to change as more and more businesses and governments accept Bitcoin, for instance. And it's starting to change as Ethereum, which is kind of a platform for decentralized finance, begins to find more uses out there. So I think cryptos are evolving into something that has kind of a coherent definition, but we still have to see what that turns out to be, and how big it's going to be. And we also have to get beyond the challenge that is going to come from governments pretty soon, because most of what cryptos have done so far have been under the radar. Nobody was really paying that much attention, but now they're starting to look like a threat to the world's governments, and those governments are starting to make noises like they're getting ready to start trying to regulate cryptos and or ban them. So we'll have to see. We don't know what the countries are going to do, but we know that countries historically, when they're threatened, lash out in really bizarre, scary ways, So it's completely possible that somebody somewhere tries to make cryptos just flat out a crime to own and to mine and to transact with. And we'll see what that does. We'll see what happens. And it wouldn't be a surprise if the U.S. was one of the countries doing that. So we will have to see. But I think cryptos are a fascinating experiment so far in private sector money that is evolving independent of any kind of a government structure. And I love the concept. But I want to see cryptos get over the hump of the government backlash before I even start trying to figure out what they are and how they are going to play a role in my own life personally.
What percentage of the population do you think is awake to what's going on?
5% at most. A lot of people are nervous, but the mainstream corporate media has done a great job of focusing that nervousness on the wrong things. So basically, at least in the U.S., most of the population has been snowed by MSNBC and CNN and Fox into thinking that the problem is just the other half of the peasants. In other words, the right-wing working class people are being pitted against left-wing working class people, while the aristocrats continue to siphon more and more money out of their pockets. And that will only change when an awful lot of people on both the right and the left, in the 99%, wake up to the fact that we actually have this aristocracy that we need to deal with before we start street battles between the Proud Boys and Antifa or whatever. That's a distraction. Whereas the aristocracy, the 1%, are an actual real enemy right now. So we will see how it goes. And, I think a financial crisis, one of the good things that a financial crisis does is that it focuses people's minds. If we have a currency crisis where there's inflation and the dollar falls in value and all the other stuff that flows from that people are going to have to try to figure out how it happened. And they'll teach themselves about the nature of money. And we'll come out of this much better educated financially than we are right now.
John, what's new at dollarcollapse.com?
Oh, same old, Jim. The world is always fascinating and crazy lately, but in a different way every month or two, So I'm just chronicling it on Dollar Collapse, and hopefully in the next couple of years I'll be able to chronicle some really consequential events that actually point in a positive direction. We will see.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Bob Hoye, and John Rubino. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Ray. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm your host, Jim Goddard. I'm speaking with Larry Ray, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, you had a great article about American Manganese in the Korean Herald. What was the story there?
Well, the interview was set up by one of our guys on the advisory board, Jim Hahn, and it went very well. Certainly, there was a lot of questions asked, and we answered them the best as we could. When it came to the technology, Zarko answered those questions, and that was a big feather in our cap. You wouldn't know it looking at the stock. We didn't put it out in a press release because it wasn't really news. It was an article. But we did send it to our eye contacts, and within 15 minutes of sending the eye contacts, the algorithm for shorting stocks kicked in, and we went down on the day, which is typical. You're getting reluctant to do press releases because these guys just gang up on you.
and they try to make it look like a piece of crap. So, but the Korean article was another step forward to us, because we have a lot of NDAs in Korea, and we've got a lot of interest in our progress and our property. And they did mention CK in the same article, and I did get questions back, saying, well, they got the same thing you have. Well, I didn't see that, and anything I've investigated, I didn't see. So that's all I can say on that. People want us to investigate every company out there that makes a claim, but most of them don't have no transparency, and so what do you compare with? There's just no comparison. And it's also a time waster. We want to advance this company the best way we can. We don't want to get sidetracked down rabbit holes by investigating other companies, because that could be a full-time job. And basically we do a quick scan and take a look, and if we can't see anything, if they don't show their powder, then what are they doing? I mean, why aren't they showing their powder if they're getting all these fantastic results? I mean, you can't reverse engineer powder, so where's the problem lie in that? Of course, you could, buy some powder and take some pictures of it, but as far as I'm concerned, it also brought up the patent protection again, which I've talked about on several times on this show, and basically, we're proud of our patents, and we're happy to have them because they're defendable. Proprietary stuff, I don't know how defendable that is. That could, smear across several margins, and it may never ever go anywhere. But the patents are special novelty, are there forever, not forever, but at least 20 years, and we've got 18 left on ours. So, we got 18 years of patent protection out there, and I've included a link to Wikipedia on patents so that people can go and look at it and wonder why millions of patents have been issued all around the world, why I'm looking at patent applications and patent grants on a special article that I get every week that indicates to me that there's probably 1,000 patents being applied for or being issued, especially in the EV car and the battery manufacturing industry. So, patents are important, and if you want to protect your investment, which is considerable, then you should be applying for patents if it's patentable. If it's not patentable, well, don't bother. And or if you're infringing on patents, don't think that we won't, stringently go after anybody that's infringing on our patent in a lawsuit. So, that's as simple as that. I mean, what's the point of having a patent to protect you and not protecting the patent? And so that's just exactly what you have to make. I think these guys that talk about the patents are the guys trying to weaken the share price, stating that the patents are just a bunch of crap and all this stuff. They obviously don't know the business. They don't know anything about patents, and or they could be competitive companies out there that have no patents, that want to level the playing field by, basically knocking down the fact that we do. And that's just to be diligent. They went after those and got those, so that was a big feather in our cap. And, we've had lots of articles throughout the last 3 years from various publications, writers, Bloomberg, Waste Tech magazines, all, just everywhere. We've had, and these were all at no cost to the company. And, so it's a wonderful thing. Now, you talk about predator trading. I've signed up, for a TV show in the U.S., and, there's, one of the principals, was looking at the stock, and he said, you better notify Larry that he's got algorithms in there that are knocking his stock down every day. And he spotted that in about 20 minutes. So anybody that's in the market should be able to spot those algorithms. We've seen them today, and you see them every day. They just come in at certain times and set up a whole bunch of trades within a second or two, go through the exchange, and usually they're sell down trades. So I've never seen an algorithm working us up ever, and so it's a predator tool that's used. And if anybody wants to take a look at that, I mean, Jesus, I don't have to talk about it anymore. Everybody else is talking about it, and other countries are talking about it, and so their predators are alive and well in the market. And there's thousands of companies in Canada and the U.S. that get abused by predators, and they must think there's a market crash coming because they're getting more aggressive. But I'm of a different opinion. I think that we're in a safe zone, and that we'll survive. We're in good shape. Cash-wise, we're in good shape to get our goals met here, the most recent goals that we've announced, and which is the final design of the plant, which is important. And I know people get impatient because we keep working on that, but what's the point of going out with something that's just not efficient or is not working the way you'd like to see it work? It's got to, we want to make sure we clear all those humps before we go into production. People keep forgetting that we have an MOU and that we're part of the design of a big 45 kilowatt gigafactory in Italy and with Italvolt, and there's a very good chance that's where our first plant will go. That seems to be the way things are going right now. Tesla's talking about having a recycling as part of their gigafactory in China and Germany. So that's the way it's going to go, and because the new rules that come in, it's going to make it tougher on everybody to have a solution that doesn't put anything back into the environment, and that's what ours does. We've got a seamless process that we want to see that runs smoothly. Just because it's seamless, it doesn't mean that you can't do the testing, or you don't want to do the testing. Just that it's seamless, you've got to do the testing, because it's just the small things in that can shut a plant down for weeks. So we don't want to have that happen. We want to get immediately into cash flow with a 60 or 90 day startup and go from there. And that's kind of the way we see things, and that's the way we develop this. I'm no scientist, but I am a CEO. I have spotted very good opportunities for several of my companies over the past 40 years, and one thing about me is if I spot the opportunity, I move on it rapidly. I'm of the opinion that there's not just me that looks at opportunities and they're thinking about moving on it too, but I want to get in there and get it done now. So that's my job as a CEO, is to direct the company, recognize opportunities, and and present them to the company and the shareholders, and move the company ahead based on those opportunities. So anyway, it's Friday, and another Friday has come and gone, and I had some questions. Hopefully I've answered some of those. I mean, even off the Korean Herald, I got some kind of questions that surprised me. That I've been talking about certain things for a long time, and they see the mention of another company in there, and all of a sudden they get hysterical and wonder what we're doing. To be very honest with you, this is going to be a multi-billion-dollar business, and there's room for a lot of companies in there. We just want to be one of the companies that leads the way environmentally and looks after the environment.
Larry, for people new to American Manganese, what's the company all about?
Well, American Manganese is a critical metals company, and we've developed a process for treating low grades of manganese, which the U.S. has and which they need, and because the manganese is critical, and and it's not part of the EV car business except in the frames and everything else, but it is, you can't even build a metal desk or anything else without steel, and if you don't have manganese, you end up with a piece of iron that shatters, and manganese is critical. And from that, that's a cornerstone of our recycling process. We were very fortunate in that I managed to keep the company intact for about a 5-year period, even though I was getting to the end of my rope because nobody was helping me finance that. And when we finally broke out in the recycling, gave a new life to the company. And everything you want to know, we've had complete transparency. I learned this in mining, that without transparency, black box technologies are just usually that. There's a lot of things that shenanigans can play behind black box. And, I've seen it all in the market before for gold recoveries and everything else. So that's why, again, our patents are important. We're proud enough to present them to the U.S. Patent Office, and now we've got the approval for the patent in South Korea, and then the other ones will be coming. It depends on how busy the patent offices are that we've applied in. But it's that's kind of our grassroots and where we come from, and so you can find all that information on AmericanManganeseInc.com. You can find us or phone us at 778-574-4444. You can email me at LREAUGH@AMYMN.com. You can check out our shares on the TSX Venture Exchange under the symbol AMY. On the USQB, you can get those under the symbol AMYZF, and Frankfurt under the symbol 2AM.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with American Manganese CEO and President Larry Ray. I'm Jim Goddard. Our conversation took place on May 7th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.